This video is an educational video only. Please pause and read the disclaimer before moving ahead. This video is brought to you by reitspro.com, the only dedicated site as well as a YouTube channel dedicated to REIT and InvIT investing in India. And I'm Gaurav Jain, and I have authored two books, one on real estate, investment and financial analysis, and the other on REIT and InvITs. So today I bring to you a 15-minute crash course where you will have plenty of basics, FAQs, as well as your nuances also to get you started on your investing journey in REITs. Although we call this a basics session, however, let me assure everybody who's associated with our channel earlier also that there will be takeaways because we have grown in our own learning over time as far as the instruments are concerned, and you would definitely have some takeaways from that. So stay till the very end. I'm very hopeful that you will be able to take away some things from here. So the first section we touch upon is the introduction of REITs and InvITs. What are they and how they are placed today in the market? Then purpose of investing. Why do you invest in the instruments? Thirdly, what are the returns which are there theoretically and in reality? Fourthly, what is the environment of investing? Here we talk about various things as mutual funds and so on also, and indexes also. Then market information and data collection. How do you collect all the data that you require for it, which is genuine and you can use for your purposes? So this is a brief recap that we will do right now on the basics. Now the REIT overview, if I were to see here, what do REITs do? They are basically trusts which are formed to assimilate rent generating real estate which is already leased out, and the rentals from there flows on to the hands of the investors. So if you look at it, investors are buying into real estate which is managed professionally and the rentals come to them. That's what basically REITs do. Now, what is the REIT legislation? It was formed in 2014, about 11 years ago, when SEBI came out with the real estate investment trust regulations, 2014. Subsequently, it has undergone significant improvements as per the market. And today we have a regulation which is much more suited to the market needs. Thirdly, what is the market history? In REITs, the first IPO happened of the Embassy REIT in 2019, and the market is today consisting of 4 publicly listed REITs, which are Embassy, Mindspace, and Brookfield, which are into office REITs mainly with different geographical markets, and the Nexus REIT, which is mainly into retail REITs. What is the nature of the instrument now? It's called a hybrid instrument, which is a combination of both debt and equity. Now, as we go along, we'll understand in our videos how it functions like that, as both has debt and equity. Now, how to buy and sell? Now, you have a minimum lot size. This lot size was very huge earlier, so you could not put your money initially unless you had a couple of lakh rupees in terms of the quantum of capital you needed into the market for REITs. But now it's only 1 unit. The issue sizes were adjusted accordingly now, and we have a unit size of 1 marketable unit in this. So you can buy and sell just like a normal equity stock. You can buy and sell REITs, just 1 share or a 1 unit. It's called a unit today and not a share, though it's essentially an equity stake in the REIT, which takes property and owns it. Let's go on to the InvIT overview. So what do InvITs do? Again, like REITs, InvITs are trusts which have ready infrastructure. They do not take infrastructure which is not built up. A very small portion of only the REITs and InvITs money is into not something that is fresh, which is called greenfield, but most of it happens to be in revenue generating assets. In case of InvITs, revenue generating infrastructure. The infrastructure list is very long today. It's called the harmonized master list and includes lots and lots of things like even ports and electricity and roadways and so on, and even schools. Now, InvIT legislation again was in 2014, same with as REIT legislation, but the over the period of 5-7 years, they have had subsequent changes in them, and amendments have also come in. And there are marked differences today, like in case of InvITs, the capping of debt, which is there, which is 70% of the AUM or the assets under management, and REITs is 50% is the capping. InvIT market history happens to be a little earlier than REITs. So in the first InvIT was the IRB InvIT, and the second was the IndiGrid InvIT, which happened in 2017. And you can see that the InvIT market is growing day on and day on right now. It's a very big market, and it is also aided by the national monetization pipeline of the government. And that is going to be a very big market today in the future, as the government also anticipates. Now, instrument is called a hybrid instrument because it contains features of both debt and equity. Why both debt and equity? Well, we'll learn, but essentially the price of the instrument is determined on the market, but the returns in case of an InvIT are more predictable as cash flows, just like in case of debt. But the market price of the units can vary. How do you buy and sell? Just like normal equity stocks. In case of public InvITs, the minimum size is 1 unit. Earlier, the lot sizes were a lot more. There was very large sizes, but now it's very easily accessible to the retail public. However, there are public InvITs and private InvITs separately, where in private InvITs, the lot sizes are far more. Now, what is the purpose of investing? Most investing happens because of risk return management preferences, which are different for different people. Again, in case of REITs and InvITs, they are people who want cash flows and a certain stability, a protection from price fluctuations. So one of the things that we do is that when we undertake any investment, we have a benchmark to pit it against. Now, is it debt? Because it's a hybrid instrument. So should you say, okay, and FD is giving me 7-8%, so does it beat debt? Or you'd say, okay, equity is giving me, say, this much, 11%, 12%, or 50%, or whatever, and does it beat that over a period of time? So these are questions that people often tend to answer in a different way. But the segment is different because these people, these investors seek stability more than anything else. They could do with a certain trade-off between debt and equity investing, but they want a steadier growth in their assets. So what happens is that in case of equities, the market can go up and down. Here, the variations are lesser. They are there. So if you see, Embassy has had a 10 to 15% variations also, but compared to the other equity stocks, the fluctuations are less. Why? Because you get a large part of, say, 10 to 15% that one gets in equity. In this case, if you are getting, say, 10 or 12% every year over a period of time, not on one place, but the 7 or 8% out of this amount which you get in REITs and InvITs, 7 or 8%, or say 70% or 80% happens to be every year. So you are protected because you are this variation is smoothened out. Every year you are getting something or the other. The price variation is a little minimal in this case, in case of REITs and InvITs. So the stable, predictable cash flows are there, and a relatively stabler unit price is there in case of both REITs and InvITs. And mind you, that does not mean that the price doesn't go up and down. It does. That's why it's a quasi equity product. Now let's assess what are the return metrics. So if you are looking at return metrics, like you just mentioned, cash flows are of paramount importance. So it's as much about cash flows as about total return percentages. So you could have recurring returns at the time of sale. And the third very important point is it's a pass-through income status in case of taxation, which means that you need to incorporate the taxation element very much into all the returns that you calculate. So you have, for example, an Embassy REIT, which is giving out, say, 23 or 24 rupees every year. And at the time of the sale, you notice that you bought it at 340 and it's gone up to 380. So that's maybe in 2 years, you've got only 40 rupees. So that's only 11%, 12% at the time of sale and increment. So 2 years, you'd say, okay, I'm getting only a 5 or 6% every year. But look at the recurring returns on that also. Every year you are getting 7 or 8%. On top of that, there is a taxation element because most of these are more than 80%, 90% either tax free or tax deferred. These 23, 24 rupees that you're getting, a large part of it is tax deferred. So your actual income notionally would be much higher. So you need to incorporate all these to get into the return metrics. And it's not just the earning, but the cash flow one looks at, which is stable and predictable and helps people manage their investment returns. The performance, like one said, is cash flows, and the performance. Let's talk about what is the theory. We've talked about the theory. Now let's see what the 4 listed REITs are, and there are several InvITs which are public and private. Out of that, we have most of these. If you have more than 20 InvITs, majority of them are private InvITs. Only few of them are public. So you need to see the cash flows as XIRRs. For that, you need to see what are the cash flows that you have got over a period of time. And for that, I have a little tool for you. So if you go to our website, reitspro.com, you can go into the resources and download files where there is a small calculator, Excel sheet, where you can put in the figures from buy and sell as well as the median returns that you've got, and just take out what are the returns that you've got, XIRR that you've got. Of course, it does not account for the taxation part, so you can put in figures accordingly. Secondly, if you want to know how much money you've got in between from any point of time, even if you don't own any of these REITs and InvITs, you can see the returns again on reitspro.com. You go and you see history of returns, and you'll be able to get this cash flows, and you can put in and see what are the different returns that have been generated. But essentially, if you look over a period of a longer horizon, you will still be able to get it. Otherwise, in a shorter period of time, one could make erroneous judgments, because REITs are more of long-term instruments, even InvITs, where you have to see it in that perspective. So what is the investing environment today? Let's see first what are the basic parameters that you have to deal with. So there are public REITs, like we've just mentioned, 4 public REITs. There are also small and medium REITs, and there is fractional property. So these 3 are different segments. SM REITs has just come in over a period of time, and then there is fractional property like strata prop and all, which you must be aware of, which is a different kind of investing. So all these can happen through the financial instruments route. However, the public REITs are where the disclosures and the environment is probably far safer, is what we feel. However, the returns could be larger in the other 2. The second is the public and private InvITs. Again, the limits on a private InvIT are far, the minimum limits are far more. It's about 25 lakhs today for a private InvIT, the trading lot size. And in case of public InvITs, you can just buy and sell with 1 unit. Every unit is priced at around 100 rupees or so was the price of issue. So some InvITs are 140, 150, some InvITs are 80, 85, and so on. So the third question is, can I invest in REITs and InvITs through MFs, and is there an index? Yes, there is an index, but there is nothing like ETF that is there which you can invest in, because the market is only maturing right now. It is not as yet matured, and mutual funds have a limit which has recently been changed, but essentially it is not more than 10% for mutual funds of the total AUM that they have. So having said that, mutual funds today still have a very less exposure in REITs and InvITs because the market capitalizations are not very huge. And because of this reason, the things like impact costs, which are more, there are no derivatives, the tick size is a little unfavorable, and then there is no margin trading in this also. So these are the things that you need to keep informed before you step into REITs and InvITs. Now let's define the purpose first and the amount. So first of all, you need to see why you're buying REITs and InvITs. They are for stability and cash flows. Don't take them as a substitute for other assets, but they have features of both equity and debt. That's what you need to be clear about. And you need to define the total amount that you would put from your portfolio before you step into REITs. So for this, you need to have a much more informed decision rather than just putting your money and then regretting later. And how do you collect the data for doing all your analysis? So the data that's auto-generated, which you see on a lot of sites, which is algo-generated, I would suggest that please don't use that data, because the parameters are different. In case of REITs and InvITs, you will be thrown off your understanding if you rely too much on the ratios and the data that you get. Please use authentic sources. Obviously, I will ask you to go to reitspro.com and see the links there which we provided. Most of the links are derived from the official websites that are there. And there is also a REIT association which have their website where you can find out a lot about what the data on REITs is, and that those are far more genuine than going for third-party data collection software and going wrong there. Tell you one more thing. Let's ignore the thank you right now. And I'd like to tell you that you are watching one of the only dedicated channels on YouTube, that's reitspro. There is a WhatsApp group which you can join, which we have several hundred members here. And this is a discussion platform that you can get. Otherwise, there is also one Telegram group. Do connect with us. And thank you so much.